Let's talk some real estate. Let's talk deals. Warren Wachsberger joins us, the CEO at ACOM Capital at ACOM, entity within the publicly traded ACOM. Did I get that right, Warren?
You did. You did. How are you, Oliver?
Great. You guys are great. Thanks for being here. You guys are private equity, essentially, correct?
Yeah, exactly. Exactly. So we're the principal investment arm. We have a series of private equity style closed-end funds investing in real estate, primarily on the development side, but we're seeing a little bit more distress, which presents some opportunities.
Yeah, that has been obviously a market kind of concern now for years, that the distress was going to turn into chaos, especially last year in the regional banks. Is everyone thinking the shoe to drop would be commercial real estate? Has that presented an opportunity, or has that gap been filled now?
Well, I think it's presented an opportunity. I mean, certainly there's a lot of defense being played across the board. 2023, things were moving pretty sideways with not a lot of transaction volume. There was a lot of extending and pretending going on with the lenders, but hopefully the markets will unfreeze a little bit in 2024. We'll start to see transaction volumes bounce back as some of the interest rate and cap rates stabilize. And then as a result of that, there should present some opportunities for offense.
What is the solution for the empty space that so many companies have moved out from? Is that an area that you're interested in, or is that risky? What do you see as kind of being the solution there?
I think office is tough. I would say that certainly older vintage office is even tougher. The interesting stat that I like to quote is something along the lines of buildings built prior to 2015 over the last 3 years, so since the pandemic, have lost something like 300 million square feet of absorption. So to put that into context, 300 million square feet is roughly the size of Manhattan or Southern California in total. But buildings built after 2015 have gained 90 million square feet of absorption. So there really has been a huge flight to quality along the lines of, if you're investing in or building new, you're probably going to be okay. If you've got older 70s or 80s vintage office, I'd be worried.
And sorry, Warren, what absorption here means? There's people in there? There's companies existing in there?
People leasing. People leasing, signing new leases or walking away from leases.
Wow. I don't know what's wrong with this building here in Chicago, though, because it's definitely, actually, I don't know when it was built, but it's pretty new and modern, but everybody's been moving out. What is it that makes the hard delineation time-wise of when you were constructed that is creating that big rift?
I think it's three things. One, people want new. So you want to go to an office with high ceilings, it feels good, you're in an elevator that doesn't feel like it's going to break. Two, ESG is a big part of it. Newer buildings generally are built to higher ESG standards. And I think as we continue to see companies move towards reducing their ESG footprint, they're looking to be in buildings that are LEED certified. And so in Manhattan, LEED certified buildings get higher rents than non-LEED certified buildings. And then three is just people want to be in environments that are light and bright. And you've got older buildings that have smaller windows and are a lot darker, and it's not as fun to go in the office. It's easier to stay at home. And when you're competing with the couch, it's you got to do everything you can to get people in the office.
Fair enough. I lost some Chicago street cred there. This is the old Montgomery Ward building. But the thing is, they've put restaurants in, they put a gym in, they refurbished a bunch of stuff. It seems like that's not enough, though. So then when you're looking for these opportunities, do you have to then figure out who's leasing if they have sustainable businesses? How do you kind of marry that construction element and architectural element with the companies that are in there, the businesses that are in there, and how sustainable they are?
So I think it's two things. One, I think that if you are leasing towards groups that are more apprenticeship-based cultures, so private equity firms, finance, law firms, accounting firms, where people need to be in the office to learn, hopefully that will sort of adjust itself and get people in there. But you're also looking at company policies. So if you look at Meta, for example, they've required back to work. And so I think you got to bet on that and hope that your building is one that's attractive. We just are in the process of completing a new building in Manhattan that we started developing pre-pandemic, and we are signing record-setting rents. It's smaller floor plates, it's new, it's not in Midtown, and people seem to like it.
How do you, when you talk with clients that are interested in getting exposure to your investments, how does it fit into the overall strategy? Do they view it as just kind of like pure real estate bucket, like an alternative bucket. They view it as yield. Or with the commercial risk, is there a speculative, is there a risk asset perspective to it?
Well, I think it's a few things. So one, you're competing a little bit with the denominator effect that's been going on over the past year. And so the allocations towards real estate have decreased as a result of that denominator effect. Additionally, you're competing against two things with clients. One is some of the mega funds, right? There's a trend to invest in either mega funds or niche, very specific funds. The mega funds, you're probably getting market beta associated with that because you're investing in a $10 billion mega fund and they are effectively getting market returns. And then the more niche strategies, you're driving that alpha. We view ourselves as a little bit more along the niche strategy and driving alpha because of our expertise in development. And as we continue to see, the supply pipeline is starting to decrease across multifamily and industrial. And our thesis is really twofold. One, when you start development next year, you're not delivering for 3 or 4 years, and hopefully you're delivering into an upcycle when no one else is developing. And so you have a monopoly on that market. And then two is there's going to be a lot of distress over the next year or two with half-built deals that we've got the expertise to step into and hopefully complete and drive some of that alpha.
All right. Looking at your guys' website now and some of the stuff you're invested in, it definitely looks like it's on the newer end, so I can see where you are following up to the analysis. Warren, thanks for the conversation. Really interesting. Appreciate it.
Appreciate your time, Oliver.
Sure thing. Warren Wachsberger, ACOM Capital.